You could get a tea or coffee for $2.
Yeah.
Now when I come back as an adult, you get tea and coffee for $8, $9.
That's crazy.
And whenever I ask people like, why is it so expensive? Their answer is always inflation.
We don't know what accounts to open up, what credit cards are, how to use credit cards, and how to even invest or budget. But if I were to kind of simplify it into 5 actionable steps. So the first thing that everyone should do.
Namaste everyone, this is Avanti and I'm here today with Steve Chen, or Call to Leap as you might know him. And today we're just going to be talking about personal finance. And finance in general is such a overwhelming word. So today my goal is to ask you 20,000 questions about why we should care about finance, what we can do about it, how each person, no matter where their income levels are, can take control of their life through that.
Thanks for having this talk with me.
Of course.
Yeah, a lot of times we don't know where to begin with our money. We don't know what accounts to open up, what credit cards are, how to use credit cards, and how to even invest or budget. But if I were to kind of simplify it into 5 actionable steps. So the first thing that everyone should do once they get out of school, once they graduate school.
From high school or college?
From high school.
From high school.
From high school, because you're 18, you can now be an independent person, is to get a checking account.
Yeah, what is a checking account? How is that different than just a regular bank account?
For sure. So a checking account helps you digitalize the money and it keeps it in a quote unquote safer place.
Okay.
When I was 18 and I started to get my part-time jobs, I used to just kind of cash in my checks or just get paid in cash. And I keep all my money in a little shoebox.
I was just gonna say, did you put it in the mattress under the bed?
Yeah. I put it in a box. And that was like just thinking back, that's a very not so smart thing to do.
Yeah.
Because of course something can happen, it can get stolen, fire, whatever, right?
Absolutely.
There's inflation, which maybe we'll talk about later. Of course, I asked my parents and they said, oh yeah, obviously you have to open a checking account. Like everyone does this. So I opened a checking account with Chase and very easy to do.
Okay.
I can now put in all my paychecks into the checking account and I can see how much money I have within my accounts on my phone. Very, very easy. So that's basic 101 stuff.
101,
right?
Just make sure at 18 you open a checking account.
That's right.
And if you're younger than 18, you can also open an account, but it has to be co-signed by your parent,
yes,
right?
Correct, yes. And then they can also open a savings account for you, which we'll talk about in a little bit too.
Yeah.
Yes, that's right.
Okay, so step 1,
checking account. Make sure that it's safe in some sort of bank and that you can take out money through ATM withdrawals, whatever it is, right? And then you can use a debit card to access that. So whenever you use a debit card, whenever you want to purchase something, use a debit card and that money automatically gets taken out of your checking account right away. So you pay for a burger using the debit card, $5, swipe it, $5 disappears from your checking account immediately.
And so you can see at any given point
Yes.
how much balance you have.
Yes.
What, in your opinion, should be the minimum balance you have in your account?
Yes, so this is a great question. At least 1 month of expenses. So if you use $2,000 every month, at least $2,000 should be in there. However, there should be an at most too. It should be at most 2 months within a checking account.
Ah.
Yeah, so if you need $2,000 every month to pay for groceries, going out on dates, whatever.
I love that. That's the second.
That's the second thing. High priority, right?
High priority. Yeah. Groceries, going out on dates,
dates,
everything else.
Yeah. So 2,000 times 2, $4,000 at most.
At most.
At most.
Okay,
yes.
So I guess the next steps are going to be, where does the rest of the money go?
It goes, yeah. Because I think a lot of young people, when they start out, they put all of their money into their checking accounts.
Absolutely.
And that is
that's what I did for years.
Yeah, right. I did that too. And there is a lot of opportunity cost because a lot of times when we leave our money in a checking account, especially with these larger banks like Chase or Wells Fargo, Bank of America, we get very low interest. And it just means that Chase, Wells Fargo, Bank of America, all of these large banks, they'll take your money, lend it to other people, and then they'll make some money off of that, and then they'll pay you a little bit of money, but the return that you get is only 0.01%. So what does that mean? It means that if you have $100 that you put into a checking account, they will only give you 1 penny for the entire year. Just to say thank you for putting your money, for using us. Yeah, 1 penny, which is totally not worth it, folks. Okay. So this leads to my second point.
Yes.
So first, we're going to have our checking accounts. Put 2 months of funds in there at most.
Okay.
Then we're going to open up a high yield savings account and not a regular savings account.
High yield savings account. Okay,
Yes.
First, what is the difference between a checking and a regular savings account?
Sure. So with a checking account, it's an account where you can put money inside and it's readily available for you to take out money, put in money, take out money. You can withdraw as much money as you want because it's your money, right?
It's like a digital piggy bank.
That's right. It's a digital piggy
Yeah.
bank. That's it. With a savings account, however, the intent for it, it's very similar to a checking account, but it's within the name. It's a savings account. You put money inside to save for a rainy day, for an emergency, your tire pops or whatever. Things that don't usually occur on a month-to-month basis, you put into a savings account.
Okay.
So that's the checking and savings. However, with the savings, there are usually some limits to it. You can only withdraw as maybe up to 6 times for most banks, up to 6 times a month from your savings account. If you take out more money from your savings account, maybe the 7th, 8th, 10th time, whatever, then they will penalize you. So their goal as a bank is to try to have you keep your money in their savings account as long as possible and not just use it as a regular checking account.
Okay.
Yeah.
That makes sense. So savings is something you put in for a rainy day.
Yes.
Now, what is a high yield savings account?
Good question. So between a savings and a high yield savings, again, it's within the name. With traditional savings accounts with larger banks, again, they also give you 0.01% interest. Super low, right? $100 put into a savings account, they only give you 1 penny back for the entire year, not month or what, for the
Just
entire
a year.
year. However, because we are in a high interest rate environment right now, a lot of savings accounts are higher yield, meaning that they give around 4 to 5 and sometimes even more than 5%. So what does this mean? Instead of putting $100 and getting 1 penny back, you can now get $4 or $5 back for every $100.
Okay.
So that is literally 400 to 500 times more money, more free money. And this is money that goes into your account on a monthly basis. 4 to 500 divided by 12, right? Yeah. So a lot of people, they, instead of putting their money into a regular savings, they put it into a high yield savings. They earn way higher interest. This is actual money that once it goes into their savings, people can withdraw that money. So it's kind of like another income source too.
So they can, it's not like it's tucked away somewhere. You can still access this money.
Yes.
And you can access the interest.
Yes, that's correct.
So what's in it for the bank then? Why are they doing this?
Yeah, great question. So because of that higher interest, it gives people a higher incentive to want to bank with them instead.
Yeah.
Because how banks really make their money is you give them money and they take that money and they will lend it to other people and they'll charge them a higher interest rate, maybe 20%, 25%. And once they make money off of these other people, they'll give you a little bit of a cut. Also, with a high yield savings account, typically they are online.
Okay.
So they don't have physical locations, right? So because of that, they don't have to pay for rent or actual employees to be here and there, right? So they can save a lot on costs. So they can pass their savings down to the actual clients.
What kind of banks would you recommend in the US? And then
Sure.
I'll share some India equivalents too.
Awesome. Yeah. So high yield savings accounts. Oh, I just want to preface, I still use Chase right now
Okay.
because of their physical locations. I can still withdraw money from their ATM machines. However, I still keep the majority of my money in high yield savings accounts. There are a lot of great ones out there. I think right now, as we're recording this,
Yeah.
as long as the interest rate is above 4%,
Yeah.
that's good. Anything below that, I
It's
would
not worth
not
it?
even, I wouldn't even touch it.
Okay.
So you can probably go with, say, Wealthfront, Ally, UFB Direct, American Express has one, Apple has one. They partner with Goldman Sachs, right? Yeah, anything that is more than 4%, 4.1, 4.2% is
And
good.
you can put it in.
Yes.
And you're saying many of these typically don't have physical locations.
Yes, correct.
So if I wanted to go to customer support, what do I do?
Sure. You can either call them or email them.
Okay.
And a lot of people might think, oh, then how do I get my money?
Yeah,
right?
exactly.
Because
if I can't withdraw it.
Right? So you would have to connect your checking account to your actual high yield savings account, right? And then you can transfer money that way.
So it's a funnel essentially.
Yes, correct.
Okay. So if I wanted to withdraw, that's why it's a savings account, because I don't have easy access to it, but I can digitally get access to it somewhere else in my holding or checkings account, and then I can withdraw that money.
Yes. And once we get a job, we get our paychecks and everything, first place the money should go into is a checking account.
Okay.
Automatically, because you need to pay for your bills, right? Groceries, go on dates. Essentials, right? Essentials, yeah, that's it. Groceries and dates. Up to 2 months of funds.
Yes.
Once you have more than that, there's no point of putting in a checking account because you're earning very low interest. Put into a high yield savings account. And for most people, it's good to build a 3 to 6 month emergency fund in there.
Okay.
That's it. Okay. If you're very conservative, if you start a business, which I don't think young people are going to start a business right away, then of course, then you can kind of increase that to maybe 12 months. But 3 to 6 months is kind of like the general rule for most people.
Of what your high yield savings account
high yield savings accounts should have. So let's go back to actual numbers.
Yes.
If people need around $2,000 per month to pay for expenses, you multiply it by 3, multiply it by 6. So 2,000 times 3, $6,000. 2,000 times 6, $12,000. They should have around $6,000 to $12,000 within the emergency fund.
Within the emergency fund.
Yes.
And would you recommend, let's say my salary, if we're using your numbers, right? Let's say my salary is $3,000 a month. So $2,000 I know goes into my expenses.
Yes.
The remaining $1,000, should I have a percentage that goes into my savings account every month, or should I wait until I've saved up that money in my checking account and then put it in a high yield savings account?
Gotcha. So yeah, we would try to fill up the checking account bucket as much as possible up to the 4,000, and then everything else that's overflowing starts to go into a high yield savings account. Okay. Yes.
So you get to that limit that you need, and then you move it.
Yes, and then you move it. Yes.
Got it. Okay, so step 1, we've said checking account.
Yes.
Step 2, high yield savings account. What's step 3?
So the third step is, now that we have our checking bucket filled up, our high yield savings bucket filled up, the next step is, once we have more money, we have our emergency fund built up, we are responsible people, right?
Yes.
We can take care of ourselves. We can then start to invest it. Okay, but only to invest. We only want to invest once we have the first 2 filled up. Yes. Okay. We don't want to skip steps here.
Yes.
So I would open up some sort of brokerage account.
Okay.
Maybe some sort of retirement account.
Okay.
For Americans, typically the best account that I really feel like everyone should have is a Roth IRA. So what's a Roth IRA?
Exactly.
Yeah, what is that?
Who is Roth?
Right.
What is Roth? Why?
Yeah, why, right? So basically with a Roth IRA, you can open up an account with Fidelity, Schwab, E-Trade, Vanguard. There's so many different brokerages out there. I usually like to go with the larger brokerages that have been around for a while with great customer service.
And what's the general, because in a lot of different countries, you'll have different names.
Yes.
Just like with the high yield savings account, you said 4% and above. What should your general principle be for a brokerage account? How do you vet brokerage accounts?
Oh, okay. I see. For me, I usually will look at 2 or 3 things.
Okay.
The first is customer service. So I'll just go online, Google, see how other people have dealt with, these brokerages customer service. Because if I'm going to have, say, $1 million in my brokerage, right?
Yeah.
Because later on in life, once we compound our wealth, which we'll talk about later, you're gonna have a couple $1 million. And I wanna make sure that I don't have to email someone, wait 3 days and then get a response. I want a response right away. So this is why Vanguard, Schwab, Fidelity, and E-Trade, right? So 1, customer service. 2, I like to see if the platforms are easy to use, because I'm not the smartest guy in the world. I just want to make sure that the user experience is nice, right? So it's easy to purchase things, it's easy to sell things. And the third is, sometimes brokerages will have interest rates on uninvested cash. So it's kind of like a high yield savings account and a investing account all in one.
Okay.
So for example, right now, as we're recording this, Fidelity gives 5% interest on uninvested cash.
What does that mean?
So that means that if you put money inside a brokerage, same thing. If you don't use that money to invest and it's just sitting there as cash, it's still collecting interest and it's still growing over time.
Okay.
Yeah, just like a high yield savings account.
That makes sense.
Yeah.
So it's a brokerage that has a high yield option, even if you are not yourself using that money to play in the stock market.
Yes.
You find a brokerage and
Yes.
you've mentioned some options and you've mentioned what you should look for in a brokerage. How much money do you put? What do you do? You know, what's the goal here?
Gotcha. So here's the thing. So let's talk about the why first.
Yes.
Why do we want to open up a brokerage account? Why do we want to invest in a Roth IRA, in some sort of retirement account? So there are many people, many Americans who live paycheck to paycheck, right? They 50%, more than 50% of Americans live paycheck to paycheck. And there are a lot of overwhelming statistics showing that people at the age of 55, 60, 65, once they reach retirement, that golden age of 60, 65 years old, they barely have anything in their retirement funds. And it's really, really sad to see this, because a lot of people have to continue to work at the age of 60, 65, 70 years old, right? And there are a lot of reports from the Federal Reserve showing that people are still in the workforce, not because that they want to, but because they have to do it, right? So I am hoping that everyone here watching this, we're able to plant our acorns now, get a solid foundation, have a good sense of financial literacy, so that this way, this won't happen to us later on.
Absolutely.
All right. And the thing with building wealth is we cannot save ourselves to wealth. We can't just put our money in a regular checking or savings account and just think if we just save money, we'll be okay by the time we're 60, 65. Wealth is really created via investing. Every wealthy person is wealthy because of investing. That's right. So that's why it's so important to start early. And we can compound our portfolios, our wealth over time, which we'll talk about in a little bit. Okay. So choose a brokerage, Fidelity, Schwab, Vanguard, E-Trade, and we're going to open up a retirement account. For most people watching this, if you're young, you're not making that much money, Roth IRA is really the way to go.
Okay.
A Roth IRA is very cool, because a lot of times you hear about people, a lot of rich people saying, oh yeah, I know how to reduce my taxes and I'm going through these tax loopholes. We can do that too, right? You and me. What we can do is open up a Roth IRA, because if we were to put money inside, invest, grow our money, and by the time we're 59 and a half years old, all that money, $1 million or so, right, is going to be tax and penalty free.
So you just get the $1 million.
You just take out the money, tax and penalty free. So very great. It's a great strategy for people who want to lower their taxes at retirement, because when we're 60, 65 years old, who wants to think about taxes again, right? So that is why the Roth IRA is very, very powerful. However, saying that, a lot of people will think, oh, then shouldn't all wealthy people just they're just gonna put millions of dollars into their Roth IRA, so it'll be tax and penalty free, right? But the IRS understands that people will do this. This is why they set some sort of limit.
Okay.
So for 2024, if you want to open up a Roth IRA, you have to make less than $161,000 if you're filing single. Okay, so there is a income limit to contribute into a Roth IRA. And there is also a contribution limit yearly. So you can't just put in $1 million, right? Right now in 2024, if you're younger than the age of 50, you can contribute up to $7,000
per year.
Per year, yes. And this number will change over time. So it'll probably be $7,500 maybe next year, or in a couple of years after that, $8,000. It'll just kind of increase as inflation also increases too. If you're older than 50, which I don't know if this is your audience, maybe you can open one up for your mom and dad. Then you can contribute up to $8,000 a year. The reason for this is because the IRS knows the statistics of people retiring with not enough. So they allow people 50 years old and older to play catch up. So this way they can contribute a little bit more money. Those are the rules for a Roth IRA.
Got it.
Now with a Roth IRA, once we open up this account, we contribute money inside up to $7,000 a year. Or if we were to divide it, it'll be roughly $583 per month. Then if we were to put $583 every month, we're very disciplined and we invest it into something called the S&P 500 in the next 30 years. It is a high statistical probability that your account will be $1 million. High statistical probability, assuming that we get average stock market returns of 7 to 10%.
So as I understand, the Roth IRA is a type of account that you would put the money into, but you would use that money to still invest.
Correct. Yes.
So it's not like I can just put my money in Roth IRA and it's going to over time grow because of interest.
That's right.
Okay.
Yeah.
I still have to actively use that money.
Yes, that's right. And that is actually the biggest misconceptions that a lot of people have. They think, if I were to open up a Roth IRA, I put in the $583 a month, it's going to grow. That is the mistake that I made too. I put it in, I was like, okay, I checked my Roth IRA. Why isn't it growing?
Yeah.
I asked my dad, he's like, what's wrong with you? You have to buy stuff. I'm like, oh, you didn't tell me that, right? So you actually,
school doesn't tell us, parents
school
don't
doesn't,
tell us,
right?
So
I Googled it, and pretty much if we want to just take the traditional boring route, we invest in something like an S&P 500 low cost index fund ETF.
Please explain what all of those words and numbers mean.
That's right.
Yeah.
So when we get into the investing world, when a lot of people get into the investing world, they go, okay, I put money into my Roth IRA. I'm going to start buying companies. I'm going to buy GameStop and AMC and Bed Bath & Beyond. I don't know, whatever it is trending, during that time. We don't want to do that. We don't want to buy these individual companies, IPOs, meme stocks, or whatever it is. It's too risky. And a lot of times it is overwhelming for people to say, which company should I buy? Because there's just so many companies out there. Microsoft, Amazon.com, Alphabet, Google, Tesla.
Also, to clarify, when you're saying buying a company, you mean buying stock in that company.
Correct.
Right?
Yeah.
People are not going out left and right and now suddenly buying the entire company and they own it.
Right. Yeah, I'm gonna use my $583 and buy Elon
Google.
Musk. Yeah, buy Google. You're mine, right? We're buying parts of a company. So we have a little bit of ownership of the company. And so instead of buying one company here and there, individual companies, what we can do is we can buy this entire index, this entire average or amalgam of all these top companies in the United States. And this is called the S&P 500. S&P stands for Standards & Poor's. 500 represents the top 500 companies in the United States. So if people were to look around in their room right now, outside at the building, look outside the window, most likely there is a brand that they see that is part of the S&P 500, like Microsoft, Apple, Amazon.com, Alphabet, Google, MasterCard, Visa, Home Depot, Costco, the list goes on and on and on. These are the companies that have proven to Wall Street institutions, all these people in suits and ties with a lot of money, right? That, hey, our companies are good companies. We are making revenue on a year-over-year basis. We know how to manage our employees. We're producing a lot for the economy. And these are the companies that we want to focus our investment towards, the entire S&P 500. So that instead of buying one company, when we buy an S&P 500 index fund, ETF, when we buy one share, we're basically buying all of these companies, a portion of all of these companies all at once. One share, all of these companies all at once. It's like a basket of stocks, right? So this is kind of like an easy way to get into investing just by investing in the S&P 500
it's
as
like,
a whole.
The way I'm thinking of it is if you have more of an understanding, you would choose individual dishes at a restaurant and go a la carte. But if you're somebody who just wants to, dip their toes, you'd buy a buffet card. And this buffet card is the food's generally overall really good.
That's right. Yeah, you get to taste a little bit of everything. So that is how the investing world works. And here's the thing, folks. For you guys watching this, at the end of our day, we want to be owners of things. Because yes, it's good that we have a job, money is coming in, but one day we will not be able to work. This is just a fact. One day we might not even want to work at all, right? We just want to relax, maybe hang out with our family, our friends, our dogs, go hiking, be on the beach or whatever.
Or not have to do work that requires this amount of labor.
That's right,
You know?
And we can still work, we can be work optional too. We don't
Yeah.
have to be tied down to a 9 to 5, right? And in order to have this lifestyle, in order to have this financial freedom, we have to own things. And the easiest way to do this is to invest in the stock market, S&P 500, where we're actually owning businesses, Microsoft, Amazon, a little piece of it.
To summarize with this, you're saying find a brokerage. You can find a brokerage separate to a Roth IRA. Roth IRA is a specific kind of account for retirement, right? Quick question about the Roth IRA again. So you're saying $7,000 per year.
Yes.
What happens if I put $7,000 today?
Sure.
That means that the rest of the year I can't put anything else in.
Correct.
But that $7,000 I can put into the S&P 500.
Yes.
Okay.
Yeah.
And you also mentioned the term ETF.
Yes.
What does that mean?
An ETF, very similarly, an ETF is an acronym for exchange traded fund. Whenever we hear the word fund, it just means basket. That's all it is. It's a basket of a whole bunch of different chocolates, a little, right?
Yeah.
So when we buy an ETF, it's a basket of a whole bunch of different companies. That's all it is. So when we put in the $7,000, we can buy a couple of shares of an ETF. So right now, an S&P 500 ETF, there are a lot of examples from different companies, but there's SPY. This is called the ticker symbol. Okay, VOO, IVV, FXAIX, that's a mutual fund, but it still tracks the S&P 500. All of these are pretty much the same thing.
Yeah.
It's kind of like Toyota has their Camry, Honda has their Accord. The Camry and the Accord are pretty much the same thing. They're very comparable to each other, right? 4 wheels, windows, air condition, whatever, right?
Yeah.
And it's the same thing with all of these different ETFs, funds, whatever. They're just from different brokerages. And they have these funds that track the S&P 500. So if you buy one share of VOO, it's very, very similar to buying one share of FXAIX.
So it's just a personal choice.
It's a personal choice.
It's like choosing which restaurant you want to eat at.
That's right. Yeah.
Okay.
Yeah. So I mean, if you want to buy fried chicken from KFC or fried chicken from BBQ Stop or whatever, or I don't know, whatever.
What other fried chicken
whatever
brands?
fried chicken brands, right? Like the fried chicken is just fried chicken. It's very, very similar, right? So, I mean, there are different ratios of like how much flour they might put in or the meat size. I don't even know. I don't know why we're talking about fried chicken. But it's the same thing. It's still fried chicken, right?
It's still fried chicken.
It's still fried chicken.
So it's still, you can't go wrong, you're saying, with most ETFs.
Yes.
And in general in the S&P 500.
That's correct, yes.
Okay.
I mean, there are some differences, but because this is more of a beginner's video, let's just keep things simple.
Keep things simple.
Keep things simple.
And just know the terms.
That's right. Very beautiful. Let's talk about compound interest.
Yes.
I know someone in here is going to take out their calculator and they're going to type in some numbers. Wait, hold on, Steve. You said that if you contribute around $500 to $600 every month for the next 30 years,
you'll get $1 million.
It'll be $1 million? Wait a minute. 500 times 12 months times 30 does not equal to $1 million. I know. And that's the beauty of it, right? Because the money that we actually put in, it's going to be around 200 something thousand dollars, right? I forgot what the actual number is. But then because of the growth of the assets that are growing over time, right? Because the S&P 500, you can buy one share for 500. In a couple of years, it'll be like $2,000 or maybe $5,000, right? As we kind of slowly buy these assets over time, by the end of that 30-year mark, you're going to see that the money that we put in, maybe say $200,000, it grew to say $1 million. And that extra money between $200,000 to $1 million, $800,000, that's like free money from compound interest right there, right? It's like buying real estate. You buy a home for maybe $500,000 over time in 10, 20, 30 years, that home is going to appreciate in value and then you can sell it for a larger price, right? That's really the whole idea of investing, putting your money, letting it grow over time, and then you can sell a portion of your assets and then use that money to live off of later on.
So I love that because most of us learn about simple interest versus compound interest in school, but trying to see how that actually applies to real life is really important. When it comes to the Roth IRA, that's something you said or any retirement account, you cannot touch that till you are 59 and a half or close to the age of retirement.
Correct.
So whatever grows is growing, and that you have to pretend that that money doesn't exist. It just exists as like a gold bucket at the end of the rainbow.
That's right.
Many years later.
Yes.
But what about regular investing? If I'm not putting it into a retirement account, if I'm going with a regular brokerage, can I remove money? Can I put it back in? What's the situation?
So that leads into our fourth step, actionable step.
Love it.
We talked about one, putting 2 months of funds into a checking account. We talked about step 2, putting 3 to 6 months of funds into a high yield savings account, an emergency fund. Step 3, once those 2 buckets are filled up, we're going to reduce our taxes.
Yes.
And put money into a Roth IRA, $583 a month or $7,000 a year.
And up to that, you can
Up
put,
to that,
you can
correct.
even put $100 a month.
Yes, you can
$50
even,
a
yes,
month.
it doesn't have to be $7,000 a year.
Yeah.
And once we have more money than that, then we're going to put it into other vehicles that can compound our wealth. Because again, we don't want to just leave our money as cash because of inflation, which we'll talk about in a little bit. Okay. So this is when we can open up some sort of IBA, TBA. IBA, individual brokerage account, TBA, taxable brokerage account. They're all synonyms. It's the same thing. Different brokerages will label it differently on their website, but it's basically a brokerage account.
Yeah.
An account where you can put money inside, a piggy bank, and then you can use that account to buy other assets like stocks. Very similar to a Roth IRA. So with a taxable brokerage account, there are no contribution limits and there are no income limits. You can make $1 or $1 million. It doesn't really matter, right?
Yeah.
You can open one up, put money inside, and you can put as much money as you want inside.
Okay.
So the benefits with this is that you can take out your money whenever you want, and you can put in money whenever you want. With a Roth IRA, there are limits. You actually don't want to touch it before 59 and a half. If you were to take out your money, you are typically going to get penalized around 10%. There are some loopholes around this. I'm not going to get into that.
Yeah.
Just keep it simple here. Okay, but generally, you don't want to touch money in your Roth IRA. Just let it grow over
Just
time.
let it grow.
With a taxable brokerage account, you can invest as much as you want, take out money as much money as you want. So there are many individuals in the FIRE community. FIRE just stands for Financial Independence, Retire Early. They will.
Oh, I was thinking firemen.
All these firemen and investing.
Sliding down a pole.
Yeah, sliding down a pole, buying some S&P 500 funds. Oh my God. They will, what are you talking about?
Okay, the full form of FIRE is financial
independence, retire early. A lot of people, they will use this account to pay for their expenses, their monthly expenses. So, for example, if you open up a taxable brokerage account, you buy these ETFs, exchange traded funds that track the S&P 500, or it's a dividend paying ETF, whatever it is. Every month, every quarter or so, these ETFs will pay you a little bit of money on top of the compounding interest.
On top of the compounding interest.
As the asset appreciates, sometimes these ETFs or companies that you invest in, they'll give you a little bit of a dividend payout. So a lot of companies like Microsoft or Costco, Visa, Home Depot, they will say, hey, invest in our company. Thank you for the $500. You know, Avanti, I'm going to give you $2 or $3 or $4 or something like that every quarter, right? Depends on every company.
Of course.
Now, they do that to reward you as an investor, like, thank you so much for investing for us, right? And they do this for a lot of institutional investors, these guys at Wall Street with, you know, the suits and ties with a lot of money, hedge fund managers, whatever. And it incentivizes them to hold on to their companies within their portfolios. They get this dividend payouts. $1, $2, $3, $4 per share per quarter doesn't seem like a lot, right? Like, oh, I'm only getting $1, I'm only getting 50 cents.
Yeah.
However, if we think about the larger picture, if we get that for one share, what if we had maybe 100 shares or 1,000 or 10,000 or 100,000 shares, right? And a lot of people in the FIRE community, they have a whole bunch of shares. They just basically collect. That's what they do. Instead of collecting Pokemon cards, they collect shares where each share pays them a little bit of money. It's very analogous where they kind of hire an employee, a team member, and that team member makes the money. right? It's a lot of people think of it that way. So they hire a whole bunch of people, get a whole bunch of shares every quarter, every month or so. They get some sort of dividend payout, and they can get like $1,000, $2,000, $5,000 every quarter or so, right?
And how much would you have to invest to get, say, 1,000 back?
Sure. Let's go back to that $1 million portfolio, right? Once we compound our portfolio to say $1 million, we're investing in something like the S&P 500 just to keep things simple.
Yeah.
Then the dividend yield right now is around 1.5%. That means if we multiply 1.5% to $1 million, that's around $15,000 worth of dividends per year that's being paid out. That will just come into your account every year. Some people will say $15,000, that doesn't sound like a lot, but a lot of people forget that there's also the asset appreciation itself. We put in the money, we purchase a home, right, and it increased in price too. Same thing with the stocks, same thing with the shares or the ETFs. We put in that $200,000, it grew to $1 million, right? And then we can actually sell some shares too. So sell the shares and also collect dividends too.
But that you're saying is this $1 million portfolio you have around the time you retire.
Yes, by the time you retire.
But me today as a 25-year-old, right? If I've invested, let's say I invest $1,000 in the stock market.
Yes.
What can I expect at the end of this year that would hold?
I see. Sure. So it depends on what it is that you're holding. You invested within the $1,000. So if you get a dividend payout of, just make the numbers round, dividend yield of 2%. So 2% times 1,000, that's going to be $20 for the entire year. Yeah. And then divide that by 4 because dividends are usually paid out quarterly. So that's going to be $5 per quarter.
And is that paid out into my checking account?
It goes into your taxable brokerage account, which then you can transfer into your checking account and go buy a burger or something. Yeah, it's real money.
Or you can reinvest that back.
Or you can reinvest it. Yeah, like you can drip. Dividend reinvestment plan. Sorry, there's a lot of, yeah, that's right.
Gen Z's form of drip is like the outfits you wear and...
I'm 36 years old. I'm like, I don't even, my drip and your drip are not
They're not the same.
Yeah.
Okay, that makes sense. And in your opinion, so since we've said, first get a checkings account, then get a savings account, a high yield one especially, then retirement, then you can invest if you have all of these taken care of, right? How much would you recommend investing in general, like as a percentage of your income, for example?
I see. As much money as possible.
Okay.
As much money as possible. Granted that all the 4 or 3 other buckets are filled up first. And then you dump everything else into investing. Because there is really no point of having money just sitting as cash. Unless we're going to use that cash for a large purchase in the near future, like maybe for a car or a home or a down payment for a home. But other than that, then we should be, like investing it, putting our money to use because of inflation, right?
So in your opinion, everything else in the bucket should go into investing.
Yes.
Right? And that makes sense because that money is now going to grow, compound over time, as we've talked about. And I can take money in and out of that, right?
Yes.
Do I get penalized for taking money in and out?
For taking out the money from a taxable brokerage account, there is no real penalty. But just some things to be aware of is that if we were to, say, buy a share for $500 and we sell it for $600, we made a $100 profit. This profit is called a capital gain.
Okay.
So this capital gain is going to be taxed because it's in a taxable brokerage account. So we're going to have to report it as income to the IRS. So I guess that's the only quote unquote penalty. We have to pay taxes. But that's with anything, with income or anything like that.
And I was going to ask, let's say you make, I don't know, $500 off of your investments, right? As this capital gain, as you're saying. Where am I paying the taxes from? As in, should I keep enough money in my checking account to account for the taxes I have to pay at the end of the year?
That's a great question. I would keep it in the high yield savings account because we still need to keep it readily available. We don't want to put the money at risk in the stock market because stock market, there's a lot of volatility, price fluctuations, right, in the short term. So we want to keep it in a place where it's liquid so we can just take it out, like in a high yield savings account.
And in most of these brokerages or places I invest, will they give me a summary at the end of the year, quarterly, whatever it is, of what my capital gains have been?
Yes. Typically, all brokerages should give you some sort of this document called a 1099. So it'll show all the money that you've made, all the capital gains, all the dividends that you've collected within the entire year.
And the taxes on that.
And the taxes that you owe? No. This is something that you're going to have to calculate yourself.
No, of course. I guess what I'm trying to say is, let's say the market did really well this year and I made more capital gains than I thought I would.
Yeah. Assuming that you sold them.
Assuming that I sold them.
Okay.
Yeah.
Yeah.
Then, so if I don't sell them, I'm not taxed on any of it.
You're not taxed. Yeah. This is called it's unrealized. It's an unrealized gain. So there is a difference between realized gain and unrealized gain.
Okay.
So people get this a little bit confused. An unrealized gain is when you invest in an ETF for $500 and it goes up to $600. You look at your account, you're like, oh, cool, I'm up $100.
Yeah.
You don't sell anything. This is unrealized. So there is no taxable events. However, if you were to go, okay, I need this money to buy dinner for someone on a date, which is usually
$600 dinner.
600, yeah, right. Who are you dating? Sorry, I don't know why I said that. But then yes, when you sell it, then it's going to be a taxable event. You're going to have to pay the $100 capital gain. That's going to be a realized gain.
A realized gain.
Yes.
And some people, because we all have heard the stock market goes up and down and up and down. So let's say I see my account today and I'm like, oh my God, this has gone up. Should I sell or should I wait? Because I could look at it a month later and it's very possible that it could also have gone down in value, right?
Yes. So this is a great question. For me and my philosophy, I like to be a turtle. I like to just keep the money in investments. Don't touch it. There will be days where the stock market will go up really high, down really low. But a lot of times when people get into the stock market, they see it as some sort of casino. They try to time the markets.
Yeah.
They go, oh, it went up, I'm going to sell. And I'm just going to buy it back when the stock market goes down. But then the stock market never goes down, it just keeps going up.
Yeah.
Then they're like, oh no, what should I do? Should I buy some more? And then they'll buy some more and the stock market will go down. They freak out and they go, I'm going to sell my shares because they think it's going to keep going down. They sell and then the stock market goes back up. So it's a very emotional roller coaster for people. I say, don't do that to yourself. Just keep it chill and just kind of add some money inside, invest a little bit, dollar cost average, just meaning that you buy a little bit of shares every month or so.
So you buy, and usually an ETF for S&P 500 where you don't have to necessarily do the research.
That's right, yes. And of course, once we become more mature investors, we want to focus our attention to more individual companies. That means that it requires us to look at the earnings reports, to really check up on our companies to see if they're really making money, right? Yeah. Then of course that's going to take some more time. So that's the trade-off. But I would say for most beginners watching this, S&P 500 funds, keep it easy.
Keep it easy. And at what point would you recommend removing funds, if at all?
I see. So if you want to, say, purchase a home or you need to make a large purchase, maybe you want to make a down payment for a home, then you would sell some of your assets, some of the ETFs, right? Some of your shares, and then collect that money and then put it into, kind of reinvest it into another asset, going from the stock market into real estate.
Into a physical real estate.
Into a real estate, yeah, that's right.
Awesome. Okay, so those are the 4 basic steps, which obviously have a lot more within each of them.
Yes.
But I'm loving the clarity. What is step 0?
Okay, step 0.
Step 0 that anybody should do when they're thinking about money.
Okay, yes. So step 0, I would say we need to learn how to budget. We need to learn how to save money. We need to teach ourselves how to put a certain percentage of our paychecks and make it a habit of getting that certain amounts, that percent, and putting it into our checking, savings, and our investments. So a lot of people who live in America, they live paycheck to paycheck. And for me, I personally believe that a lot of it stems from our habits and what we've learned from when we were kids. So I understand that everyone, we were dealt different cards. And when we grew up, we probably saw our parents struggle. Maybe we saw our parents in credit card debt,
Yeah.
And they get further into credit card debt as time passes, or they don't talk about saving money in a checking or savings account or investing. So all of this is very unknown, unfamiliar to them. So because of this upbringing, then a lot of these cycles are then repeated down generations of, oh, it's normal to be in debt. It's normal to not invest. Investing is gambling. Putting money in a savings account, it's not that necessary. We can just keep working and using our paychecks to pay for things month after month and just live paycheck to paycheck. That's a normal thing. But this is not a thing to continue the cycle of. So we want to break this habit, and regardless of where you start off with whatever financial situation you have, there are actionable steps to take, right? We can break out of these cycles, right? It's going to take some time. It's going to be very emotional. But I believe as we take these little baby steps, it becomes easier. So the general rule is we need to make sure that we save at least 20% of our paycheck. We do not touch. It is for future me.
You're investing in your future self.
Yes, correct. Like it is not for like Steve right now or Steve for Saturday or Sunday. We need to put 20% of that paycheck somewhere else so we don't touch it.
And the rest, 80% expenses.
Sure.
Anything that you want to buy for fun, etc.
Yes, that's right. Our needs and our wants.
Our needs and our wants is the 80%, and the 20% almost doesn't exist.
Yes, doesn't exist. Yes, it is not for you.
It is not for you.
Yes. And of course, if we want to save more, increase that 20% to 25, 50%, which I know a lot of people are going to be like, 50%, that's not possible. It's possible. It takes time to get there and a lot of willpower and, like, again, a lot of these habits. Right? But the more we can save and invest, later on, we hit financial freedom. We achieve financial freedom much earlier.
I love that. Now what is the last step? Now that we know the instruments we can put our money in, we know the principle we should have to be smart about our finances and not spend everything. What's the last step?
The last step is, as cliche as it is, but it's so true. We need to keep learning. We need to keep increasing our skills. So with building wealth, it really comes down to 3 pillars of wealth. It's to save money, it's to invest our money, and then to earn money. Or some people will reorder that: save money, earn more money, invest money. That's really what it is, right? But the problem with this is, with saving money, there's only so much we can save, right? And then, like, what else do? I don't have anything else to put into my investments or high yield savings or whatever, right? And investing, that's pretty automated, S&P 500, easy. So once we hit that roadblock and go, hey, I want to live below my means, I master lowering my living expenses every month, and then I'm going to now learn skills so then I can increase my income. The wider this margin is, the faster we get to financial independence. And we have to keep it like this, because what I found is a lot of people, they start learning new skills, increasing their income, and sure, their income will go up, but then all of a sudden, this starts to go up too. So basically, they're just doing this right here. It's not getting wider, it's just kind of going up like this. So there is this thing called lifestyle inflation. Make more money? Oh, awesome, I want to get myself a new BMW and a new upgrade to this. And I'm going to get that vacation package and upgrade my room to da-da-da-da, right? So we don't want to do that. We want to make sure that we try our best to keep our costs lower, right?
In all areas of your life, then you're truly educating yourself. Education doesn't mean, oh, I've done this test and I've scored XYZ amount, right?
Absolutely.
Or reading a textbook. It's about, am I curious about life, the things that help mine, and hopefully the more you grow, that help other people's lives as well. And how do I learn? And today we have all these tools. Like, if someone's watching this video, they shouldn't watch this video and say, I have now learned everything about personal finance. No, I've learned so much from Steve, but it's been an amazing introduction. And based on what you've said, everyone should go and do their own research and come to their own conclusions.
Yes, that's right.
This has been a really insightful conversation. Thank you so much.
Thank you.
I think, it's really important to demystify topics that feel really confusing, and I really appreciate how you've done it in such a clear manner. To do a quick sign off to this. Okay, so we're gonna do a little rapid fire finance section. What, Steve, is inflation?
Sure. I used to have this really rare Pikachu card that no one had at school in my classroom. It had this little stamp. It was so rare. No one had it, right? And it was worth a lot of money. But then later on, when the company decided that they wanted to print out more of these exact Pikachu cards, then the value of my Pokemon card, my Pikachu card, started to go down. So inflation is kind of like that. It's when money, the value of money, starts to depreciate over time, right? A lot of times when we think we have $500 right now, $500 can buy us a certain amount of things.
Yeah.
However, later on, that same $500 can't buy us the same thing anymore. Costs of goods and services will eventually rise. Burgers nowadays are like, what, $5, $6? And I know this sounds ridiculous, but later on, it may be 30 years or so, it could be, say, $10, $15, $20. I remember when I used to go to McDonald's, a hamburger was 29 cents and a cheeseburger was 39 cents.
Yeah. Every time I come back to the US, I experience sticker shock.
Yeah.
Because I remember when I grew up here as a kid, you could get a tea or coffee for $2.
Yes.
And now when I come back as an adult, especially in LA, you get tea and coffee for $8, $9.
That's crazy. Yeah.
And whenever I ask people like, why is it so expensive? Their answer is always inflation.
Inflation, yeah. And inflation has risen a lot more in the past couple of years. This is why it is important that we don't just keep our money in our checking accounts, because if it just sits there, sure, that $100 looks nice, but the buying power will depreciate over time. And
the
that
value.
the value depreciates over time, and it'll go down to, say, $50,
Yeah.
$40 later on.
And then just one last term I'm curious about, because we hear about it all the time in pop culture. We know that celebrities like Taylor Swift are billionaires, but not just billionaires, their net worth is $1 billion.
Yes.
What does that mean? Does that mean she has $1 billion in a combination of checking and savings and all of the things we've spoken about?
That is a great question. I think a lot of times when people hear, oh, Taylor Swift has $1 billion net worth, or, oh yeah, I have $1 million net worth, whatever, they think they make $1 million every year. That's not true. It just means how much you have in terms of assets. Assets are like actual cash, or maybe a property, right? Or a car, a couch, stocks, ETFs. All of those are assets.
Yeah.
And that's the value of all of that, right? The value of your couch, your car, your home, how much money you have in the bank. And you then calculate your liabilities. Liabilities are how much you have in debt. So it's like, oh, even though I have $1 million in the bank, well, I have $500,000 of debt, right? So then you subtract the liabilities from your assets, and that gives you your net worth. How much you actually have minus how much you owe, that is your net worth.
And would an expense count as a liability?
Sure, yes, because money is leaving. Yeah.
Okay.
Yeah. Mm-hmm. So if you have a credit card, say you put $2,000 on a credit card, then that's going to be an expense, right? That's going to be deducted from your net worth.
So everyone has a net worth, is what I'm hearing.
Yes.
It may not be $1 billion, but you can calculate your own net worth.
Yes, that's right.
Well, thank you so much for doing this, Steve.
Thank you.
If you haven't checked out Steve's page, it is Call to Leap. Please check it out. It really, and also he has an amazing budgeting tool, since we spoke about budgeting and the importance of it. I think it's so cool how he breaks down things step by step, and I appreciate this. Even though I learned so much from this is like not even scratching the surface of what is possible. And go check out his page if you want to know more. And if you want to know more about just other topics in general that feel really scary or demystifying, and you want to demystify them, please let us know what else you want to see.
So if you guys want to learn more about money, actionable steps, that is something that I love talking about on my channel.
Does amazingly.
Yeah, thank you so much. Yeah, so I talk about actionable steps. I make it very easy to understand because, again, I come from a public school teaching background. You can check out my page on Call to Leap, or you you can go to my website. Avanti talked about my budgeting sheet. I have a budgeting sheet. It's all free. I have a lot of free resources, right? Free sources. I have a PDF that talks about the actual steps of what we talked about here today on where to put your money step by step into a checking, high yield savings. I have my favorite high yield savings accounts all in my website, all on my page, so you can check that out. If you don't know what credit card you want to get, I have a list of my favorite credit cards, especially for beginners too. And yeah, hopefully you guys learn a lot from my page.
Yes, it's a one-stop shop, so please go check it out. Go subscribe as well to Steve's YouTube channel. That is Steve's dog letting us know that we should really finish this video.
Domino's coming in.
Okay, bye.
Thanks guys, bye.
The tension is so strong. Oh, I wanna go there. I can see it in your